Most traders talk about markets in terms of price, how high, how low, how far, how fast. But time is not just a neutral backdrop, time is a constraint. Trends don't end only because price moved too far, they end because they've lasted long enough. In this video, I'll walk through weekly, monthly, and multi-year structures, not as prediction tools, but as a framework for understanding when markets are more likely to transition. Price is what we see, time is what limits. Markets can stay overbought, oversold, euphoric, or depressed much longer than people expect. Reversals feel surprising because price-based logic ignores duration. A move often ends not when it becomes expensive, but when participation becomes saturated and the time budget of that trend is consumed. The weekly time frame is the shortest rhythm that still reflects institutional behavior. Funds reassess risk weekly. Performance is evaluated weekly. Exposure is often adjusted weekly. That's why weekly highs, lows, and especially weekly closes matter. Many regime shifts cluster around weak boundaries, not by magic, but because decision-making has a weekly cadence. Weekly time is not just a line, it's modular. Markets often react around recurring week counts because real-world processes create periodic pressure points, reporting cycles, risk reviews, rebalancing, and positioning. This doesn't mean price must reverse on a schedule. It means sensitivity often increases at these time intersections, and that's valuable context. Monthly structure reveals behavior that daily charts often hide. Capital allocation, portfolio evaluation, and exposure adjustments frequently happen on a monthly cycle. Month-end closes can signal participation. Is money committing into strength or fading the move? Monthly timing doesn't predict direction. It helps you distinguish real trend development from noise. As we zoom out, structure becomes clearer. Quarterly and annual timing are less about entries and more about regimes, transitioning, consolidating, or extending. Many market shifts look messy on a daily chart, but become obvious on higher timeframes. Markets rarely change character instantly. They transition through time. Big moves rarely happen in isolation. They cluster. Major trends, long consolidations, and large reversals often form within multi-year timing structures. That's because large-scale capital takes time to build and time to unwind. What looks like a sudden breakout is often the visible release of pressure that accumulated quietly over years. Trends are temporal phenomena, not just directional ones. During accumulation, price compresses and time passes while pressure builds. When balance breaks, the trend persists and participation expands. But the longer a trend lasts, the more it becomes crowded and saturated. At that point, time becomes the enemy of the trend, and the probability of transition increases. Time is not a crystal ball. It won't tell you what happens next, but it tells you where you are in the market's life cycle. Used correctly, time gives context. When risk expands, when patience is required, and when expectations should change. For systematic trading, this matters because markets change character over time, and strategies fail when they assume conditions are constant. If you start treating time as structure, not superstition, you stop reacting to noise and start responding to context. This is educational content, not financial advice.